Thank you for joining us today. My name is Omar Jordan. I'm the founder and CEO of Coviance. And before I introduce our guest on the call, I wanted to share with you what led me to ask our distinguished guests to join me and share their decades of experience with the audience. For the past 12 months, I and the team at Coviance have done a tremendous amount of research on how to help our customers navigate through liquidity challenges. And in this industry, we've gone from having too much liquidity in 1 year on the balance sheet and then into another era where there's not enough of it. And one day I ran into a webinar that Frank and Jeff did with FHLB on this topic. And it's the first time I ever saw someone provide substance that I felt every bank and credit union should absolutely listen to and learn from. And that's why I asked Frank and Jeff to ask me here today. And so we're doing a two-part series. In the next hour, we're focused especially around banks, and some part two of that will be regarding credit unions, and that's another webinar that we'll share with you, and I think that's happening tomorrow. But I'm thrilled to welcome our guest, Frank Farone, Managing Director at the Darling Consulting Group. Frank consults nationwide with CEOs and CFOs of financial institutions to increase earnings through the productive management of capital, liquidity funding risk, interest rate risk. He's a frequent speaker and an author on topics related to industry issues and trends, funding solutions, regulatory issues, and much more. And then Jeff Croteau, Jeff will have to correct me if I said that wrong. Jeff assists with financial institutions, executives, strengthen their assets and liability management processes. In this role, he provides custom solutions for managing interest rate risk. So Jeff, Frank, I'm so excited to have you on. Let's get it going. Let's give our audience a taste of some of the content you've been putting out there, and I'm really excited for this.
You said it perfectly, Omar. Thank you for having us.
Awesome.
Thanks, everybody, and thank you, Omar. I'm so delighted that we have an opportunity to get in front of your customers, your clients, and so you're going to run this for me, Jeffrey? All right, great. So let's get started. And our objective today is there's a lot of things that we're going to talk about that are pretty obvious, right? Things that you already know, but I think there's probably some things that might have been overlooked during times of stress on the liquidity side, stress on the margin side. A lot of changes have taken place, but we want to put some things into perspective and share with you. This is my 5th decade of doing this. So I'm going to share with you experiences that I've had over the decades, and then bring that to where we are today in the environment and talk about how you can take advantage of certain opportunities in today's market and give you some ideas for things that may have been overlooked by some of us in this environment. We're running another webinar right now concurrently with this one, and it's all about balance sheet strategies, not just liquidity. And we have every 50 state represented and almost 1,000 people on it. So I'll share that with Omar that he can share with you. But what it suggests is, these are some really challenging times. And again, not to overstate the obvious, but we came from a period of very, very low rates, lower than we've ever seen in our lifetime. And here we are today. We've got high rates. We've got an inverted curve. Inflation, well, maybe we're at the end of the inflation scare, but we came off of a period where we had historic growth on non-maturity deposits that Omar referred to. And our composition of deposits went, almost 90% non-maturity deposit. Nobody wanted a CD, and that has reversed itself rather quickly. And that's creating a lot of challenges. And so we're going to address those issues. We came off historic low yield assets that a lot of us now were, so to speak, stuck with. And so sometimes that gets in the way of some of the things that we think you want to consider today. The recent bank failures that we're all aware of, that's put a premium on your ability to be able to discuss your liquidity position, your contingency liquidity plans. Jeff's going to talk about all that, but I can tell you there's a heightened focus on liquidity. And so what we hope to share with you today is how we approach liquidity, how we measure liquidity, and how you can find more liquidity in your balance sheet and off your balance sheet. The whole updated liquidity guidance, Jeff's going to address all those issues so that at the end of today, you'll have a rock solid, bulletproof approach to liquidity measurement and liquidity management. And so we were at historic lows. You know, some of us have been in the banking, quote unquote, banking industry longer than some others. And so this change that's going on right now, this metamorphosis in some of the ratios that we're up against for liquidity, loan to deposits, the use of wholesale funds, you know, it's on the upturn, but I can assure you, right, this is not unusual. And we are still a long way away from where I think some of these challenges are going to bring us. So if we look at loan to deposit ratio, I only went back here to 2002, right? But there was a point in time when loan to deposits were about 90%, right? And then, you know, if you look at that 2008 timeframe, right, we had the great financial crisis, and what happened? Loan to deposits came screaming down. Why? It's because loans came down? No, it's because deposits poured in. We went into recession, the Fed cut, and all of a sudden now you look at the wholesale funds when we were at 90% loan to deposits, those came down as well. How come? Because we had all this influx of deposits, right, to pay down those wholesale funds. And as you can see in the red circles, that's starting to change, but we're still a long way off from where we were. It was not unusual to see loan to deposit ratios at 120 to 130%. And I'm going to share with you why a loan to deposit ratio doesn't really give you a clear picture of what your liquidity position is. And yet some of us have loan to deposit ratios as part of our policies. And I'm going to suggest to you, that's not a very useful metric, right?
That's a good point, Frank. I had a Rodney Hood, 11th chairman of the NCUA on a former podcast. That's the number one thing he mentioned was it's a misconception at that credit union and bank level between the relationship between loan versus deposits and what it means in the liquidity big picture. So I'm glad we're diving into that.
Yeah, and I'm glad to hear that from a regulator, right?
Oh, yeah.
So, good to hear, right? And I used to be a regulator back in the 80s, so I can share some of my stories with you. So, Jeff, if you go to the next slide, you know, one of the things that we shared with clients, right, having been through so many decades of recessions and rate changes and inverted curves and loan to deposits going high and then low, is when we had that influx of deposits, it was no surprise to us when we started to see that massive shift out. And so one of the things that we shared with clients was, and if you look at that graph on the right side, that was last September. If you were to look at your ALCO package, you look at your asset liability management package, just about every single institution looked like if rates stayed right where they were, that's that base case bar graph scenario, life was pretty good. Here's the challenge. And then if we had a little bit change in rates going up, we felt a little near-term pressure, but ultimately life is pretty good. Things moved in a positive direction. One of the common shortcomings, we'll call it, was many institutions didn't build into their model that as rates rise, or even if rates were to stay right where they were, you're going to see continued out-migration from non-maturity deposits, either outside the bank or having to replace it wholesale. So we felt it was important just to recognize that that's a high probability event. And if we were to run non-maturity deposit migration, in this case, we chose 25%. Look at the difference between the graph on the right and the graph on the left. So it begs the question, which one are we? It all comes down to the assumptions. We think that the graph on the left was a more reasonable, rational, plausible scenario. So then the question becomes, if that were to materialize, How much of an impact does it have on our income? And what are the things that we ought to be thinking about now? Now, that's old news. Let's go to the next slide. This says it all, right? There's a lot of stuff on this page. And again, this is nothing new to you, but let's just start with COVID. When COVID hit, and you can see where all of a sudden, if you look at that orange, that was a huge influx of non-maturity deposits. We all know that. But what do you notice? Right after that, you start to see all these negative numbers below the line, which was CD growth. So what was happening? Rates came so low, all those CDs migrated into above the line, which is growth in non-maturity deposits. Roll the clock forward, and all of a sudden, you see the reverse.
Yep.
Now, all of a sudden, CDs are growing, non-maturity deposits are coming down. This is very typical. It's a classic late rising rate cycle behavior. So now it begs the question, what's next? Well, if you look at the CD migration that I showed you after COVID, after the Fed started raising rates, right? Here we are today. We came off about the 85% non-maturity deposit concentration, and you can see it's starting to decline. CDs are starting to move up. If you go back to the last time we were in a similar rate environment, 2007-ish, curve was flat. It was before we went to the deep downturn financial crisis. It was about a 50-50 mix. Look where we are today. Similar rate environment, and yet look at the wideness between non-maturities and CDs. Something tells me, unless we have a rapid decline in the long end of the curve, we're going to start to see that converge more. And if that's the case, I think you need to be prepared for that migration. And I know everybody wants more liquidity. Everybody wants to raise deposits. How do we get deposits? Jeff will share with you how you go about doing that, and if and when it even makes sense. So expect more shifts ahead. Next slide. All right. Our data scientists, this is their forecast, and that is even if rates stay the same, you're going to continue to see non-maturity deposits decline. And our forecast is about 11% more. Whether rates go up or rates go down, you're probably going to see anywhere between, let's just call it an average of 11% decline. So prepare for that. Yep. Go to the next slide. So if that's the case, one thing that we would encourage you to do is to build that into your model at Alco, whether you run your own, whether you have a vendor do it, whether we do it for you. If we do it, we already do this for you. But what would be the impact moving forward from here of another 10% non-maturity deposit migration? And as you can see, if you slowly ramp that up over time, the graph on the right looks like, well, if rates kind of stay the same, we're doing okay. The graph on the right says, we're not doing okay. And I know this institution, and we're in the middle of budget season right now, and it doesn't look good for earnings. And so if in fact we have another 10% migration and there's not a lot of growth in this particular market, we've got to go to plan B to make up for that loss in income. And I'm going to talk about that later too. And it's going to require borrowing money. And so if we're going to borrow more money to put on wholesale leverage to offset some of that, right, we have to make sure that we've got a very robust liquidity management process in place. Okay, measuring and managing liquidity. This is the same slide that I use when I talk to the regulators. And so it all starts out with, how do you define liquidity? This is our approach. This is what JP Morgan uses. Our definition is the ability to raise money quickly without losing money and at a reasonable cost. What's a reasonable cost? Market rates, whether it's brokered CDs, FHLB, local market rates, but that's our definition of liquidity. What it doesn't mean is that we have to have cash flow coming in over the next 12 months. Cash flow coming in over the next 12 months does you no good if you need the money today. So we've got to be able to raise money quickly without selling anything. We want to pledge securities or pledge loans, and we want to get it at market rate. So if you believe that's a reasonable, rational definition of liquidity, then unrealized losses in the investment portfolio, right, is irrelevant when it comes to liquidity. We don't have to sell those. And yet we hear every single day, we have people calling us saying, we're looking at selling securities. What are your thoughts on that to raise liquidity? 99.9% of the time, the answer is that's probably not the best thing to do. Let's look at some alternatives. So we're going to walk through that too. So if you believe this is a reasonable definition, then let's go to the next slide. Right? Again, I'm not going to spend much time on this, but this is where a lot of people get hung up. They get hung up on these unrealized losses, creeping up, creeping up, creeping up. What this ignores when you look at unrealized losses is, number one, these ultimately are going to come back to par, number one. Number two, what's offsetting these losses? You probably have unrealized gains on the liability side in the form of non-maturity deposits, right? So again, we throw that out to you. If anybody is considering taking losses in the investment portfolio, call Jeff, call me, and we'll get through it. So this lends itself now to the approach that we take for what we call a total liquidity solution. There are two banks here. One on the left, it looks like they've got very strong on-balance sheet liquidity. The one on the right shows they've got very tight on-balance sheet liquidity. And when we walk you through how we measure liquidity and how we manage liquidity for Bank A and Bank B, at the end, I'm going to tell you the end. The end is they have the same, even though one looks like they're tight and one looks like they're strong. So the one on the left with strong on-balance sheet liquidity, they've got about 25% on-balance sheet liquidity between cash and unencumbered securities. The one on the right looks tight because they don't carry a lot of cash on balance sheet for their asset size. They're about 5% of liquidity versus 25%. So let's go to the next part of liquidity management. We looked at on-balance sheet liquidity in the form of cash and the ability to pledge and borrow against securities that are unpledged. Take those same institutions, and we're going to go down to the next level. Now, right, I've got the ability to access money through pledging loans at the Federal Home Loan Bank. That's that tier 2. Now, the bank on the left has a 25% policy guideline for borrowing at the Home Loan Bank. The one on the right has 45%. Why not give yourself the absolute maximum flexibility for accessing the Home Loan Bank? Now, some of you look at 25 and you fall off your chair. 45, you might give you a heart attack. Some of you have 10%, which begs the question, why? Where did you get 10%? So we want to know on one page, the ability to access money quickly at a market rate without losing money. I have access to the Home Loan Bank. I can pledge my securities. And then tier 3 is brokered CDs, right? The one on the left has a 10% policy. The one on the right has 20%. And so at the end of the day, on one page, based on that definition, I've got 32% liquidity and I've got 34.5% liquidity. And for both of these, we built in a buffer of 5% runoff or 8% runoff over the next 30 days. So almost 40% liquidity.
I got a couple of questions for you on this. So you and I spoke a while back, and it was just a cell phone conversation. I love what you said to me, and it's just stuck in my head. Leveraging the FHLB relationship and pledging home equity loans, right? Home equity loans right now is the #1 consumer requested loan by credit union members, bank customers, and yet we're seeing some hesitance, right, in maximizing that opportunity. In my opinion, after talking to you, is just why not maximize the home equity lending channels to lend, and I think you said at a fixed interest rate, lock it in at a high fixed interest rate to maximize that yield. Can you touch on that a little bit?
Sure. So again, when we look at liquidity, we're not looking at cash flow or cash sitting in overnight Fed funds. We're just looking at the ability to access cash, right? Yeah. So if I have the opportunity, or if your listeners have the opportunity to put on home equity loans, whether they're fixed or floating, right? And I can use those loans, whether I can pledge them to the Home Loan Bank or not. If I have the ability to book those loans today, and I'm getting yields that are probably 3%, 2.5% to 3%, maybe even more above my cost of raw materials in the form of funding, And the curve is inverted right now. So you might decide, I can fund that short. If it's floating, I can fund it out 2 years, take advantage of the inversion in the yield curve to support that. Because I know 2 years from now, if rates are higher, I don't care because I've got so many assets that are repricing out beyond 1 to 2 years from now. So whether you fund it short or you fund it out, the fact that it's a high yielding asset where there's a lot of action today because everybody's locked in. I mean, we all locked in 2% mortgages, 3% mortgages. So I'm not going to refinance my loan today. I'm going to go to a home equity loan. And so it's something that a lot of our clients are using. A lot of our clients are promoting. You know, at the end of the day, if you're comfortable with the credit, then it's an asset. We can always go get the funding, whether it's broker, whether it's Federal Home Loan Bank, but it's an opportunity right now that I think
Huge.
Is ripe. It's huge. So yeah, good question. But again, you need to make sure that you don't get hung up with ratios, right? That get in the way of you having the ability to execute on some of those strategies, right? Some banks will say, well, geez, we only have 10%. I had this yesterday or 2 days ago when I was in New York with a fairly large institution. Their borrowing limit is 10%. They're at 7%. You look out at the next 90 days, they've got more loan demand than they have deposit growth. And the question is, so what are we going to do? You're going to blow outside those policy guidelines? Change the limit. Where did we get 10%? I said, if I were you guys, I'd make it 45%, right? Not 10. So give yourself some flexibility. So thank you, Omar. That was good timing for that. All right, so let's go to the next slide. Now, this is, I showed you like side by side, bank A, bank B. This is the basic surplus approach that I just showed you. This is an example of a bank. And as you can see, we've got it highlighted down at the bottom, right? Where they are, basic surplus, tier 2 basic surplus, and tier 3. And you can see where their policy guideline. This is a very, very conservative bank, my client. So it just shows that these are their policy guidelines, and we actually use the Federal Reserve. Now, for those of you that haven't, just about every single one of our clients tapped into the BTFP program. That should be a part of every single one of your liquidity, as part of your liquidity management process, having access to the Federal Reserve. Have as many arrows in the quiver as you have. FHLB, brokered CDs, Federal Reserve, ICS, Stone Castle, all of those should be a part of your overall liquidity management process. And then Jeff will walk you through all the things that you need to have in place as part of a contingency plan. So if the regulators ask or have concerns, you can walk them through how you manage your liquidity. Fair statement?
Fair statement.
Okay. One thing that we all know, one of the reasons why SVB had some challenges and is no longer here today is they had a lot of uninsured deposits. Regulators want to know what's your level of uninsured deposits and how are you managing it? How are you managing potential outflows? We listed a bunch of things on the right side of the page, which I won't go through. You can go through those on your own, but I would make sure I knew what that number was. And then I would make sure that I knew of all of these deposits greater than 250, how many of them are uninsured. And for this particular bank, we went through and it was less than half of what these numbers were, right? So make sure that, you have that ready if and when the regulators question that. Okay. Now, if you think about the basic surplus approach that we took, at the end of the day, your basic business is you buy and you sell money. You take money in, you do one or two things. You either lend it or you invest it. That's your raw material, right? And what generates revenue at the bank? Loans and investments. Raw materials is money. So we just basically took inventory through the basic surplus approach of our liquidity and our access to liquidity, or basically looking at raw materials and access to raw materials. Now what I want to know is over the next 90 days, what is our expectation for changes to our liquidity? Net new loans, and then net deposit flows. What do you notice here? We've got more need for funds than we have funds expected coming in. So if there's a shortfall, the question becomes, what do we do? Well, I look at your investment cash flow. That's not enough to support the shortfall, which means what? We're going to have to look to alternative funding sources. And then that begs the question, where do we go? So that's why it's important. Take inventory of your funds and then look at your 90-day forecast and then plan from there. Okay. Derivatives. I talked a little bit about the liquidity side. One of the things that some of you may or may not have access to is derivatives. Some of you, I'm never going to touch a derivative. Our board can't get it through. I've got little banks, $200 million banks that use derivatives very, very, very effectively. And I've got multi-billion-dollar banks that are afraid of them, all right? It's not how big or how sophisticated you are, but this is a tool we think every single one of you should have. Right now, if you look at the lower left section of the page, if you can highlight that, let's just go up to the 2-year point of the curve. Right now, if you've got margin compression right now, and you're looking at ways of how can I reduce my funding costs, right? You can put on a 2-year pay fixed swap, meaning I pay somebody $478, they pay me a floating rate of, let's say, 3-month SOFR, 538. 22 and 38 is what, 60? You actually get paid 60 basis points. So if you have to fund assets and you have to go to the wholesale markets, you can go to the home loan bank, borrow short, and you can create funding at 478. I'm going to give you an example. And by the way, most of you, once you look beyond 2 years, you probably don't need a lot of long funding, right? You can hit that inflection point. So I probably wouldn't go out longer than 2 years for most of you. I'm going to give you an example, and this is like going back in time. For some of us, we're going to have to continue to grow, to muscle through this environment and this inverted curve. The question becomes, and we did this a year ago, this is what we look like with our growth plan. This is what we look like currently. This is what we look like with our growth plan. But we didn't run out a lot of funds. So what did we do? You go to the next slide. What if 50% of that surge ran out the door? That's $217 million. Now what do we look like? Oh, we don't look so good. So now what do we do? Go to the next slide. Well, if we're going to put this loan growth on, and we're going to go out long with these things, we need to buy protection against the outflow of those deposits. And that's when we put swaps on. And for this particular bank, if you notice, they don't really have a lot of exposure once you get out beyond 3 to 4 years. So we didn't need to put on swaps for funding beyond 5 years. So we did 3, 4, and 5-year interest rate swaps. And I think it was like in the 1% range or thereabouts. And then I think, then we combined it. Now this is what we look like. We put the growth on, we put the swaps on. Now look at where we are. We're in a much better place. I think for many of you today, you're going to have to continue to grow, whether it's through loans or whether it's through the investment side, wholesale leverage. But you're going to have to continue to grow. And to the degree that you need to buy some protection, whether it's near-term or long-term against rising rates, swaps are a very valuable tool and resource. And we would encourage you to add that to your tool of resources for risk management.
So Frank, if you were, let's put your bank CEO hat on, what's the first thing you would do to strengthen your liquidity position?
Well, I guess it depends upon where do we start? Number one, do we have access to the Federal Home Loan Bank? If not, you should. Do we have access to the broker CD market? Do we have access to some of the other resources out there? And then what I would do is I would make sure that my policies give me the flexibility to do what it is that I need to do. There is a lot of liquidity in your balance sheet today that's untapped because you've got very restrictive policies. You might have all the collateral in the world, but if it's not pledged and your policies don't give you the flexibility, right? I have clients that have 135% loan to deposit ratio, and they don't get a 1 in liquidity, but they don't get a 3, which begs the question, how could you be that borrowed up and still get 2 in liquidity? And it's all because the process, the contingency plan, which Jeff's going to talk about, and making sure that the regulators are comfortable that you guys have everything in place from a liquidity perspective, that we don't have to worry that there's going to be another SVB situation. And that involves running stress tests and some other things. Does that answer your question, Omar?
It does, and it's interesting. I'm learning too as I'm touring the country recently. There's policy, and then there's practice. Some of them have the ability to go up to 45%, but their practice historically has been much less than that, and therefore they're too afraid to go there, even though their policy allows it.
You know what? Maybe what we'll do, I'll send you an article that I wrote probably 20 plus years ago called "Mirror, Mirror on the Wall, What's the Fairest Funding of All?" And it addresses all of the, I'll call it excuses or impediments for utilizing the wholesale markets. And it breaks it down, everything from a business perspective. And I've had more boards read that and say, you know what? We never looked at it this way. How come we haven't changed our policies?
Yes.
We should have done this 20 years ago. So I'll send that to you and you can share it with your group. What's next, Jeff? Oh, you know what? We could spend a whole day on this, but you can read this at your leisure. Probably the most important thing, this goes back to Omar, what you just talked about is the very first bullet, you've got to be able to support and defend your liquidity position and how you manage your liquidity. And it's all the things that we talked about and all the things that Jeff's now going to talk about in terms of what are the other things that are part of this total liquidity management process.
Thanks, Frank. And before I get into stress testing, contingency funding plans, and just some considerations from a process standpoint, I'm going to spend a couple of minutes on deposits because in today's liquidity challenged world, we got to at least talk about deposits. Now, in the interest of time, I can't get into the level of detail that I'd like. We have other resources on our website, which I'd be happy to share with Omar to distribute to the group. But here's a couple of areas that we're talking with our clients frequently about currently. One is retention. Frank shared the stats with you. That has been challenging the last 12, 18 months, and we expect it to continue. Deposits are leaving the industry. We're seeing a massive shift from lower cost non-maturities into higher cost funds. So we're seeing a lot of turnover, especially in our lower cost accounts. So how do we combat that? One suggestion would be we have found groups who have actually had success with comeback or win back campaigns, who are some of my largest customers that have withdrawn funds over the last month, 3 months, 6 months. For some of us who might have more competitive offers today or be willing to play ball from a liquidity challenge standpoint, do we call those folks to win back some lost funds? We've had some success there. On the money market side, I'd encourage everybody to review your tier structure. We work with a lot of clients where their highest money market tier is 100,000 or 250,000. We analyze where the balances reside. 60, 70, 80, 90+% of the balances might reside in that highest tier. So as we were increasing rates this year, and to give yourselves flexibility on the way down as well, think about getting a little bit more granular from 100,000 to $1 million plus, spread out some of those concentration buckets, again, give you some flexibility. On the CD side, I bet most of us on the line today ran specials or promotions back in the summer or late 2022 to get at that first wave of Fed rate increases in our rate sensitive customers. I'd also be willing to bet a lot of us have large buckets, larger than usual buckets of CD maturities coming due in the next 3, 6, 9 months. So have we game planned for those buckets of maturities? What can we potentially get away with from a retention standpoint? And how is that factoring into our liquidity planning for 2024? And then this theme of staying active, even if we have the data or if we have the mechanisms in place to look at some of these trends, it really does need to be part of the DNA and the culture of the bank to be looking at this stuff frequently and acting upon it if we really want to drive change and actually grow deposits, using data. Here's a few things that we've seen within our data set. We've already beat this point home, so I'm not going to spend much time here. This is what we've seen in our data set at an account level of CD growth in 2023 so far. Strong portfolio growth of almost 40%, but about half of it came from the non-maturity deposit portfolio. So as we are coming out with those 5.5% CD specials, we're all aware of this. It's just important to keep in mind it's costing us more at the margin, as we know some of this growth is recycled from our own balance sheets, and we're seeing, the spread, coming from those lower cost non-maturities to those CDs at a differential of almost 400 basis points. So again, we need to be aware of these trends and how much marginal cost of funds or cannibalization is occurring on my balance sheet. Here's an example of an early warning system for a retention or attrition standpoint. We found within our data set, if you have customers that are withdrawing funds every month for consecutive periods, they're at a higher likelihood of closing than any average account. So do we have early warning systems built out to help flag potential depositors at risk? Here's another example. Here's a group of large balance accounts, a lot of 50, 100,000, 250 plus that are getting paid low interest rates.
Right.
These are all getting paid below 1%. Some of these are single source. Some of them are newer opened. Some of these are even premium money markets that came to you in 2018 or 2019 when market rates were half of where they are today. And they're getting paid a lesser rate on that money market today. So if I had $100,000 and, that was, the rate sequence, I would probably be looking elsewhere as well. So can we potentially get in front of that and identify some customers at risk and hold on to them before they go shopping? So that's just a couple of minutes on the deposit side. I'm going to spend, the next 10 minutes or so before turning it back over to Omar on some considerations for risk monitoring, contingency funding plans, and stress tests. Because at the end of the day, this stuff is required from a regulatory standpoint. And given all the challenges Frank discussed earlier, the expectation or the bar has been raised when it comes to liquidity management standpoint. So we need to ensure that we've kind of dusted the cobwebs when it comes to these processes in advance of our next examination. But more importantly, having a robust process is going to give you the flexibility and give you an edge strategically to run a little bit tighter or to give you the flexibility to manage your funding base the way you desire.
And confidence too.
And confidence. A lot of the times it's with the examiners, but processes like these instill confidence in board members and senior management as well. So it can go a long way within your organization's walls just to have a more confident and strong process. Starting with risk monitors, what I mean by that is examiners expect you're going to have a list of key risk indicators from a liquidity perspective, and it's going to be an early warning system that lets us know of a potential liquidity threat. So here's a few must-haves from FDIC and examiner feedback. Many banks just have a policy or a guideline limit. So loans to deposits, we have a limit at 100% or 110%. Why don't you have an early warning system at 90, 100, then 110 to prompt conversations and allow us to think strategically well in advance of reaching a policy limit? We don't just want to have a line in the sand and say, once we breach this, we must take action. Because we can trip some of these limits and it not be a big deal. We want to have qualitative responses that range from not a big deal or we're going to keep an eye on this to, oh boy, we got to take action. And that needs to be well documented in our contingency funding plans as well. I'll spend some more time on that later. A host of variety of indicators. Most groups just look at loan to deposits, a few wholesale funding metrics. What about some credit quality components? Think about funding concentrations, especially in today's day and age. Everybody's expecting that you track uninsured deposits. If you have public, ICS, any other funding concentrations above 10%, I'd be tracking those items. Can we look at anything from more of a leading indicator perspective versus a lagging indicator? And then these need to be under constant review. There was interagency guidance that came out in July or August of this year. It was all about contingency funding plans, updating your stress tests, and ensuring that those are fluid and reflect the risks of 2023 and beyond. So if they haven't been updated, I'd highly suggest that. Just quickly, this is an example of one of our risk monitors that kind of highlights some of the things that I was talking about. This group's looking at 20 indicators, depending on the size and complexity. It might be 10, it might be 30 for some groups, but this is going to be unique to you and your balance sheet. Here's the early warning system. So if you have a true policy or guideline, it goes in risk level 3. Now this way we're notified well beforehand. The prompt conversation gives the examiners ease. And again, it's going to benefit you strategically as well. And then here's one of the other points that I mentioned. Just because we trip a risk indicator doesn't mean we enact the CFP or have to take particular action. It means we have a conversation and assess the risk. So we need to have multiple levels here, again, ranging from not a big deal to we need to start to take action. And again, I'll get to that right now, but that needs to be documented in our contingency funding plan. So first thing where we see a lot of shortcomings is documenting the roles and responsibilities. So if you don't list out who's in your crisis force and what their particular responsibilities are, your examiners will likely ask. Defining risk tolerance and escalation. So that's what I just mentioned on the prior slide. As we start to trip a certain number of indicators, or once we reach a point of discomfort, what are the specific actions we're going to take? Specifically listing out our different funding lines. If we're going to slow down lending, everything should be on the table. And again, that's going to be unique for every institution. Number 3 is kind of an art and a science. You must list in there, how you came about your stress testing process or some of your key risk indicators. But if you have too much detail, you're going to be reluctant to make any changes. And we had groups that were actually afraid to make positive changes to their stress testing process after the bank failures in April and May, just because it was in their policy that wasn't going to be updated till January. So you need an out so you can be nimble. Again, review constantly. I don't need to keep harping on that. Number 5, this is important. We've always recommended emergency contacts, but that is even more important now with the SVB failures. Time's of the essence. That was a shock to see significant deposits leaving in an afternoon. So a 30-day or less window from an operational and generally contingency is fine, but we need to demonstrate that we have intra-week and intra-day plans, especially if our business model calls for that. So I would list all my funding sources, who I would contact to obtain them. How long does that take? Does it require collateral? Is the collateral already in place? If we got to move collateral, what does that look like from a settlement time standpoint? Are there any risks associated with obtaining this funding source? Say, could it be revoked for any reason? I would have that all documented out, and I would periodically test my lines. We always want to do this periodically, no matter if we're in good times or in desperate times, but especially when times get tough, we want to test those lines and ensure that they're there.
Hey, Jeff, one thing, Fed fund lines.
Yep. Yeah.
I can assure you, unless you've used the Fed fund line recently, they don't exist.
Yep.
Omar, did you have a comment?
Oh, no. Well, I do have a question for you at some point, and it's related to, it might be something you've already touched on, but I'm curious, it's a question that came from the audience. What is the common ratio where you see community banks setting up too much stringent policy limits?
So Frank kind of touched upon it a little bit, but I would say the wholesale funding is a very common one where we do see a lot of groups at 15, 10% or even less from a total wholesale perspective. Cash or on balance sheet liquidity could be another one too, where it's especially easy today it's especially easy to say today when cash is yielding 5.5 or in an inverted yield curve. But if rates fall back near to 0, are we going to be comfortable holding 10% of our balance sheet, let's say, in cash? So we want to be cognizant of different environments and again, giving ourselves flexibility.
Brokered CDs. Some banks don't even have access to brokered CDs. It's like, well, there were a lot of bank failures that they got in trouble with brokered CDs. The brokered CD didn't get them in trouble. It was the loans that were funded with the brokered CDs that never paid back. That was the problem, not the brokered CDs. We could have done the same thing with high cost CD specials too. So some of the old, traditional approaches, banks haven't made changes, and the world is changing, and it's changing fast. And so a lot of this comes down to education and education with the board to get them comfortable, as opposed to just, this is what the regulators want.
Yeah.
I know I got one more section here. I know we only got about 5 minutes or less before we open it up for questions. So I will speed through these last couple of slides. I'm not going to spend much time here because Frank already showed you a similar schedule with the basic surplus. This is just the idea of, we really need to hone in on our near-term forecasting over the next 90 days, what we're expecting on the loan side, deposit side, how might that affect my liquidity position on a go-forward basis. And as I transition to stress testing here, it's a good idea to start wargaming with some of these cash flows. Let's say some of my prepayments came to a screeching halt and I continue to originate at the same levels. I might have a shortfall of liquidity. And if that event were to arise, how might I fund it? Do I have enough dry powder? Do I utilize the wholesale markets? We want to be prepared for those conversations versus being reactionary. And same thing, what if I continue to see deposit outflows? Again, playing with some of these variables and how might we react is going to keep us better prepared. And then that needs to segue into stress testing. So what if things go wrong? And I'm not going to go through all of these, but here's a checklist of things that I would consider for your stress testing approach. But just to kind of sprint through in 60 seconds, we don't want a sensitivity test. We want these to be ongoing, going out a year or two with your business activity built in. We need to have institution-specific defense of our assumptions. So if you're running out 10% deposits, have you done a deposit study? Why isn't it 5? Why isn't it 15? Having documentation and quantitative support. Think of idiosyncratic. What would an examiner look at on your balance sheet and try and poke a hole in? I just talked with a group last week that had 20% of their deposits in one NAICS code or one industry code, and it was dominated by just a couple of relationships. So you bet the examiners are probably going to ask them about that. We're running that off in a stress test unique to them. But again, what's on your balance sheet that would be expected to you to reflect as a risk? Concentrations is an easy one. Any funding concentration, I would be running a scenario. And again, just this idea of constantly updating and that interagency guidance stating, we expect these to be refreshed. What are some 2023 business risks and beyond worth considering incorporating into your stress test if you haven't already? I think the lowest hanging fruit there is an uninsured deposit or some funding concentration runoff in a short window of time. So here's just one example of blue bars, and this black line represents total liquidity. The green line is our policy. This bank ran this prior to their exam late this summer, just to get ahead of it, build in a 2023 narrative. They wanted to run something that would break the bank. Here's something I recommend everybody does: run relief or remediation scenarios. So take that poor stress test, the one that breaks the bank, link it up with your CFP, and actually model out a few actions that you would take in a draconian type scenario like this, and demonstrate what you would do to buy yourself some more time. Helps with the examiners. And again, there's been plenty of instances where it's given comfort to the board or senior management as to how much liquidity they actually have access to. Here's another example where, again, I'd be running off uninsured or surge deposit runoff, and in a short window. Most stress tests, we kind of decay over time, over 6 months, a year. Do this immediately, as short as you can. I would even do it first bucket. Now, what's interesting, this group ran off a substantial amount of deposits, and they ran one of those remediation scenarios to show we wouldn't even have to pare back lending too much. And since we have a lot of wholesale dry powder, we would stay within our policy limits, even if an amount of deposits that we can't see leaving left the bank. So again, this gave management, more comfort that they had more liquidity than they actually thought they had. So with that, just to summarize some of the key takeaways, we want to identify the liquid asset or appropriate on-balance sheet cushion. But as Frank walked through, we need to have a more holistic approach, and it's all about our access to cash, not just what we have on the balance sheet. And we really do need to have an appropriate and solid stress testing framework in place and have the right risk monitor in place to allow us to manage our funding base the way that we want. Because at the end of the day, it really is about educating and defending key stakeholders within our organizational walls, and especially the examiners, as to why we're comfortable operating the way that we are. So with that, thank you very much. Omar, I'll hand it back to you for closing remarks.
Well, I'll open it up for Q&A, but and for the audience, there's a Q&A section. Please dump in or drop your question in there, and I'll surface it up to Frank and Jeff. But just in summary, for me, it comes down to policy and approach. Are your policies hindering you or hindering your ability to expand access to liquidity? And it seems to be a theme across the board sometimes. And then the approach, what is your definition of liquidity? And it seems to be more focused on deposits versus loans and asset to loan ratio. And I think that's the misconception that I'm on a mission, and it seems you, Frank and Jeff, are on a mission to help us educate not only the people in the seat who are doing the work, but also the board at the board level, to give that comfort to expand some of these policies that are potentially hindering the ability to maximize the opportunity. We talked about in one of the forecasts you showed, you're projecting balances to decline next year. Where do you think we'll see the largest balance declines?
It's going to be in the non-maturity deposit sector, and primarily the lower cost. Some of those legacy money market and saving accounts that might be sitting there at 5 basis points, some of those larger accounts, we're seeing those migrate off the balance sheet. They could be going to Treasury Direct. They might be getting a 4.5 yield at Apple or whatnot, or they might be taking advantage of the 5.5% CD specials that are out there in the marketplace. So there's going to be an overall likely reduction in total deposits, as well as a large shift in mix from lower cost non-maturity deposits to premium high yield savings and money markets, and especially CDs.
What about large balances, Jeff? When we look at some of the clients, you tend to see some large, big chunks, right?
Yep.
The tiers that you talked about.
Exactly. And there are often times where a lot of the larger balances have already moved. They've already moved into our first wave of CD specials. Those are our exception priced money markets that are at 4%. And they're going to continue to be knocking on our door if rates continue to change. But we're seeing a lot of movement in the what I'll call middle tiers that have clearly some excess or discretionary or investable funds. They might be $50,000 to $200,000, and we're seeing pockets of that. Again, moving into higher rate CDs or just leaving the balance sheets in general.
So on the topic of deposits and deposit migration, what do you think are the best strategies, right, for banks to put forward in order to grow deposits? Is it continuing to offer those attractive CD rates?
It's tough because you can't just throw rate out there and, just because I have a 5.5 or 6% rate that I'm just going to all of a sudden attract a certain amount of deposits. Right. You look at all these markets out there, there's not a lot of differentiators. Most people are kind of in this 5.25, 5.5 range. So even if we go out there at 5.5, I don't know if we're going to necessarily grow a lot of our deposit base, and we might recycle a lot of those funds at higher rates. So one thing I would certainly do is kind of differentiate retention from growth plays. Yeah. Are there ways that we can retain our existing customers at 25, 50 basis points less potentially, and have other products and services that are meant to drive new growth? Absolutely. And we can even have options in there where we're not excluding our existing customers. I know some people, get a little nervous when we broach the new money topic, but there are ways we can still include our existing customers and just have them bring additional wallet share for them to maybe squeeze out an extra 50 basis points where, hey, we have this great retention product, but we will give you top of the market and allow you to shift funds into this if you bring an extra 20,000 to the table, let's say.
Right. Well, on the product side of things, that's so huge. It is retention. Deposit migration doesn't happen if you don't have products to keep that customer, right?
Yep.
And for me, if we focus on the home equity product, for example, we see a lot of banks, credit unions lend up to 80% loan to value, where fintechs and other larger institutions are lending up to 100 or 130% loan to value on a home improvement type loan. And therefore your borrowers, your customers are having to go elsewhere because they need that product. Credit card interest rates are now at a 30%, APR. I'm paying that with a 700 plus FICO score. I can't imagine what someone is paying that doesn't have that capability. So the $10,000 balance just went from $400 a month to $600-700 a month in payment on my credit card. Well, that's a pressure that I'm feeling as a consumer, and I need my lender, I need my bank to maximize my ability to access that asset, the equity that I created in my house. And that's what's interesting about this market. We're seeing home values continue to rise, interest rates continue to rise. It's been a very, very, I want to say, predictable yet unpredictable year to see the market trends, and it's been fun to watch and just learn from it. And I hope the industry gets to really feel that level of confidence on that you guys put forward. So I think I just want to thank you guys for taking the time to do this with me. Tomorrow we're doing another segment that's specific to credit unions. Today was specific to community banks and banks in general. So Frank, Jeff, means the world to me that you're able to share your knowledge with our audience. And if anybody wants to connect with Frank and Jeff, I'm happy to email me directly, and I'll make sure I do a warm introduction to either or both. So thank you, gentlemen. I appreciate it and look forward to connecting with you again tomorrow.
Thank you, Omar.
We're delighted to be here, and we'd be delighted to help anybody in terms of looking at their policies, answering any questions they have offline. Happy to help. Thank you again. Our pleasure.
Thank you. Thanks you all for hanging on. Appreciate it.
Thanks, everybody. Have a great day.